Hello, 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 my dear friends. So let's get started. Co-working Startup Incubator, together with British Council, welcomes you on our fourth webinar. Today, we're going to talk about venture capital and how to get funded by venture capital fund. So let me please introduce our today's speaker. Please meet Ales Pustovrh. He's the founder of the ABC Venture Accelerator and the partner of the venture fund, Phil Rush Capital. Also, he is a Doctor of Sciences and a lecturer in the university. So now I hand it over to you, Ales. Please tell our participants how to find the investments in a venture capital.
Thank you, Paul, and hello, everyone. I've met some of you in London a couple of years ago. I have very nice memories of the time when we could still travel, huh? And hopefully we might do that again someday. I would like to share my screen with you. I have prepared a few slides, but most importantly, I would like to tell you a story and essentially explain to you how investors think and what do they want to hear and what do they don't want to hear also. But some of these things are pretty complex and it's not so easy to really understand. So feel free to stop me, feel free to ask any questions. You can also write the questions in the chat if you want. You can simply stop and say, Ales, I don't understand, you know. So let's try to make this conversation. I think it's a nice small group so we can easily talk about it. We don't need to make it too formal, okay? So ask me questions, okay? Now, I would like to share this and ask you if you can actually see. So can you see my presentation on full screen now?
Yes.
Yes.
Perfect. Excellent. So allow me to talk to you a little bit about how to raise money. But maybe before we start talking about how to raise money, it's also a good question to understand why to raise money. You know, if maybe you remember, or if you think about it, there are two ways basically how you can create a new company. Okay, how you can create a new business. The traditional way how you make business is you create a business and you earn some money and then you invest some of this money back into the business and you grow the business. But essentially you grow the business through the money that you earn. You don't, you know, especially in the early days, you are way too risky to go to the banks, so the banks will not really give you a loan, and usually there are not many other possibilities. So usually, and that's how you used always to create business, in the beginning, the growth is quite small because you don't really have enough money to make it very fast, okay? And now, I think some 50 years ago, the Americans discovered that there is a second way how you can do business, and mostly in the last 20 years, the second way has become the main way how you create new companies, new business. You actually don't really sell things and you don't finance the growth of your company just from the money that you earn. You can actually have higher cost, invest a lot into marketing, into sales, into other things, and you finance this loss through investments, through investors. Now, it sounds a little bit strange. Why, you know, why would you want to make loss? Why would you not want to have profit? What do you think? Why is it a good idea for Facebook to, you know, be making loss for 5 years in a row before they made the first profit?
Taxes.
It's not just taxes. I can guarantee you that the big companies are very, very good in avoiding taxes. They have mastered the fact that they don't pay any taxes. There is another reason. What do you think? Don't be shy.
Guys, yeah, if you have any thoughts, just turn on your mic and tell us. What do you think?
Why is, and I like the case of Facebook, even though it's an old one, but it's not the only one. You know, you can also talk about Spotify, or you can talk about the Romanian company called UiPath. You know, why did these companies, and how can these companies become from zero to Spotify, I think was worth more than $10 billion. UiPath from Romania is already worth $35 billion, and it's still growing. And they were able to do that in less than 10 years, in a very short period of time.
Because they have many customers.
For sure, but if you find, if you find a problem which has many customers, what is the first thing that's going to happen to you? You start your business in Kharkiv, and you discover that, wow, everybody in Kharkiv really, really need what I'm selling, okay?
Okay, that you get copied, so they...
Exactly, you get competition. So essentially, the real competitive advantage in front of your competition is simple, and it's simply to be faster. Facebook was not better than Google. Facebook was not better than some other solutions. Facebook wasn't even the first one. MySpace was before Facebook, but it was the fastest one. So if you discover something that can create a really good business, people will copy you. Other companies will copy you. There is no intellectual protection, no patents that will, really help you avoid the fact that somebody will copy you. Okay, but if the potential for your company is really big, in a short period of time, you can actually, gain a lot of customers if you invest a lot of money into growth. If you invest into marketing, if you employ a lot of people. Facebook was employing hundreds of people before they made any money. If you have salespeople, developers, big office space, essentially a lot of cost. But you are creating an organization, you're creating a structure that can actually become a global company, a very big company. And the way how you do that is that you finance all of these costs from investments. Okay, so somebody gives you money so that you can become very big, very fast. Okay, so how do you do that, and how do you convince people who have money? In most cases, these are professionals. These are not, this is not a local guy who inherited something from his mother and said, oh, I'm going to invest into startups. In most cases, these guys are professionals. They only do this. They only invest money. And they see a lot of companies. And every single company that they see says the very same thing. We are the next Facebook. Every single one, okay? We are going to grow fast. We are going to make you rich. We are going to be $1 billion company. Give us the money. And a large majority of this company will never provide any return on investors' investment, okay? So the real key here is, and I can also give you the numbers as a partner in a venture capital company. This year alone, I have heard more than 1,000 startups asking me for money. Okay, by the end of the year, I'm pretty sure we're going to reach 2,000 startups. All of them are asking me for money. Some of them are good, some of them are bad, some of them are fake, and we as professional investors need to recognize who is who. Who do we invest into? And we actually do invest into quite a lot of companies. I think this year we're going to probably make around 50 investments, but I'm going to listen to 2,000 companies. So 1,950 companies that will come to me, ask me for money, will not get my money. Okay? So how do I make a decision? How do we make a decision? Who do we invest into and who not? I think the first thing to understand is exactly the story that I've told you now. A lot of companies, and in a large majority of cases, these are technological companies. These are oftentimes IT companies that say, wow, we are the next Facebook. And sometimes they say, oh, we can get money. And then they get money, but they don't really understand why. What companies need to understand is money is here in order to fuel your very fast growth. Okay? If you say, I need money so that I can develop my product, you're probably not going to get money from us. Most venture capital companies, they don't really provide money for product development because it's too risky. We provide money for scaling up your business, to grow your business. There are exceptions. Even we invest a little bit of money into companies that are still developing the product. We have a limitation. We invest a maximum of 50,000 euros for 10% of the company. in companies that don't have any revenue yet, that don't have any turnover. So understand, when you are asking for money, money is there so that it increases the value of your company, which basically means that you increase the size of your company, that you grow, and that you grow very fast. The fastest growing company that we have right now in our portfolio has been growing 45% per week. It's exceptional growth, okay? Okay, they will not be able to sustain it very long, but still, if you think about it, most companies that I know, they don't even grow 45% in 2 years, okay? These guys do it in 1 week. They simply need to employ people, they need to invest into marketing in order to really, really grow their company. So understand this, that essentially the reason why you're raising money is not to develop the product, it's basically you want to increase the size of your company, okay? Sometimes we call this very simple. Venture capital or capital investors are like gasoline, like benzene that you throw on the fire, okay? You need to have the fire, but once you put gasoline on it, then it really starts burning very, very fast, okay? This is what we are. Do you say benzene in Ukrainian language? You know what I'm talking about?
Yeah, in Ukrainian and in Russian also, yeah.
Okay, so you understand what I mean by that, okay? Cool. I have a lot of topics that we can discuss. Some of them will probably be a little bit too complex for you, so don't worry if you don't understand something, ask me questions, or we can also skip it. But do understand one thing, that if you decide that you're going to create fast-growing companies, or if you see an opportunity to create a fast-growing companies, and that you will finance your growth through this, from getting money from professional investors like us, you will spend a lot of time doing this, okay? A friend of mine was able to get €1.5 million investment, but he had to, in 9 months, he had to have 150 presentations. For 9 months, he was doing nothing else except raising money, getting the money, okay? So fundraising is your full-time job. If you think that this is going to be easy, it's not easy. If you think that this is going to be fast, it's not fast, okay? Sometimes it is the only option, and for sure, always it's the best option. Now, how do you convince investors like us that we really should give you some money, we should invest some money into you and not into somebody else? Tell me, how would you convince me? I can give you some money. It's a process, but we have a venture capital fund with more than 40 million euros that we invest into companies. How are you going to convince me to give you the money?
We need to show you some traction.
That's one thing, but why traction?
I mean, every investor wants to see what did you achieve already right now, what sales do you have, how fast are you growing?
For sure, but why? Why is the sales so important for us?
Because it's the main indication for a company, for a startup. So if you have good sales, if you're growing fast, then you're doing everything right, correct?
It's actually a little more simple. A company, any company, exists because some people have a certain problem, and they are solving this problem simply by buying the solution to the problem. If you have a car, you have a car because you want to drive from one point to another point. And in order for you to be able to drive from one point to another point, you need benzene, you need gasoline, okay? That's why petrol companies exist. They help you solve the problem of moving from one place to another, okay? And when you come to me and say, listen, Ales, I know that there are people who have the problem and I can solve it. I have developed a solution to this problem. If you don't have any revenue yet, then I simply have to trust you. I have to believe you that there is a problem and that you have a solution. For me, these are two types of risks. One, is there really a problem, or do you just think there is a problem, but the reality is no, not really? And second, even if there is a problem, have you really developed a solution to this problem? Okay, so these are two risks. Once you have revenue, once you have some turnover, the first risk is eliminated. For sure, there is a problem because some people have already paid to get rid of the problem with your solution. So you are minimizing risk for investors, you are eliminating risk. And essentially, this is the key element when you want to convince people to give you money. You need to create, first of all, as small risk for them as possible. Why as small? Because startup companies and new companies and small companies, by definition, they are very, very risky. Okay? Now, if we can lower this risk, this is what investors would like to see. At the same time, of course, investors also want to see a lot of potential for growth. We want to see that if we give you 100,000 euros, that maybe in 10 years' time, this will be worth 1 million euros. Okay? So, companies that grow very fast usually have a cycle of 12 to 8 months when first they raise some money, they get, let's say, 1 million investment, then they spend this money on the cost that I have been talking about, so marketing, sales, maybe some additional features development or whatever. And then after 12 or 18 months of growth of something that moves them to a higher level, to a bigger company, more valuable company, they're without money again. So usually then they raise again. It's the second round. And then the third round. Facebook, I think, had 4 or even 5 investment rounds in a period of, I think, 8 years altogether. Okay. So if you have decided and if you believe that you can grow your company in this very fast way, okay, that means that you will be raising money not once but several times. Okay. And usually you should raise the money for the next 12 to 18 months, then spend the money, get your company to a higher level, to a better, more valuable position, and then get more money. Okay. I see we have a question. I just don't know. I just don't see it. So Rosa says, are the investors giving funds in month 0 that the execution will take place with a delay at 12 months? Well, investors usually give you a certain amount of money. So let's assume that you need, I don't know, 1 million euro a year to really grow very fast, okay? That means that you should be raising probably 1.5 million euros from investors, okay? Because this is going to give you runway for 1.5 years. So investors will give you money in the beginning, but they're going to give you so much money that you're going to be spending that money in the next 12 to 18 months. But before you reach 0 money on the bank account, you should already be raising the next investment round. Usually the next one is bigger one because usually you need more money to grow even bigger. Okay. So Rosa, does that answer your question? I'll talk a little bit more also about how much time it takes to actually get the money. It's not in 1 month or 0 months, it takes some time, but it actually shows you how much money you are looking for. You shouldn't be looking for money that will last you for 5 years, because that's not going to happen. And you shouldn't be looking for money that will last you for 3 months. You should be looking for the amount of money that will last you for 12 to 8 months of rapid growth, okay?
What I meant is, when you raise the first money, will these investors be fine that you spend some more time raising more money rather than executing the money that you just have received from them? Are they happy with delays?
No. Essentially, what the investors are doing, they are supporting your business development plan. So usually, the reason why you would raise more money immediately is because you didn't ask them for enough money. So if you ask investors for money that will last you for 3 months, you immediately need to start raising money again. But in this case, the initial investors will not be happy and will say, listen, we will not invest our money if you will just keep raising money and keep raising money and keep raising money. Okay. Okay.
So you need to do both things at the same time.
Essentially, you are always doing both things at the same time. Yeah. Okay. And for sure, some other things as well. So developing the business, raising money, hiring people, developing the product, you know, being a founder, being an entrepreneur. is not an easy life choice. Okay.
Yeah. Thank you.
But this slide actually showed you how much money you should be asking for. Okay. Now the second thing is, okay, now you know, okay, I need 1.5 million to increase the size of my business. How do you get investors interested? Well, first thing is they need to see the potential that you see. Okay. If I get another startup that will pitch me a new logistical solution, maybe with blockchain logistical solution, I will scream, because I've heard so many in the last few months that and none of them succeeded. Okay. So I simply don't believe them that they will do something good if so I will not invest money if they come to me with another idea that I've heard for 10 or 15 times. So you do need to capture my imagination, and you can capture my imagination by showing me how big this company can grow. Okay. If you right now have a company which has 100,000 euros in revenue, and you say, you know what, I can create a company that's going to have 1 million euros in revenue, I will say, that's too small. You know, I'm not interested. I need to see if you can create a company out of 100,000 to 100 million. This is the kind of growth that, you know, captures my imagination. But you can only do that if you're solving a big problem, if you're essentially trying to create a global company. Okay, Ukraine is too small to create these kind of companies only on the Ukrainian market. So you need to show me how big this can get. You need to also show me that in the future, I will be able to monetize this. So if I give you 1 million investment, in 10 years time, I will need to sell this investment to somebody and get money. So whenever venture capital investors are investing money, they are doing this with a very simple expectation. In the next maximum of 10 years, we will sell our share of the company. Let's assume we get 10% of the company. We need to sell this. And by far the most typical way how we sell our share is that somebody buys the whole company. So this is now a question for you. Are you open to this, that if you get our investment in a period of several years, your company will be sold, hopefully for a lot of money? I can tell you right now, many founders are not happy with this. I'm always surprised, because let's be very clear on what we are talking about here. You have a company now, you have some sales, and you say, but we can grow much faster. We can grow 3 times a year for the next 3 years. So I can create 10 times bigger company in the next 3 years, from 1 million in revenue to 10 million in revenue in 3 years time. But in order to do so, I need to get some investment. I need to get somebody who's going to give me the money. We said, okay, we're going to give you the money. But after 3 years, when you actually do what you told us you're going to do, you raise your company from 1 million to 10 million. Said, okay, cool, we are happy with this. Now we want to get our money back, meaning that we are going to sell your company. But to sell your company, buyers don't just buy our stake, they buy the whole company. So they also buy your stake. So after 3 years, somebody else will be owning your company. You know, not a lot of people. There are some people who don't like that. Why would you like it? Would you like this if in 3 years' time somebody buys your company?
Sounds like retirement.
I can tell you right now, it's not, for a very simple reason. These guys that do that are usually serial entrepreneurs. So what they do is they sell the company for 100 million. We get our 10 million, you get 90 million. So absolutely you can retire. And I know some people that did so, but usually then they create a second company. They have some initial money and they invest this money into the next company. So these are then serial entrepreneurs. You see a lot of them everywhere, but a typical case, there are several typical cases in the United States. Elon Musk is a case like that. Jack Dorsey as well. He created Twitter and he created Square. Okay. So they create a company, they sell the company with the money that they get. They don't go on vacation and live happily ever after, but they create the next company. And sometimes this can happen many, many times over. So in order for us to give you the money, we need to understand how big this can get. Can we sell the company? Okay. but also how risky this is, how likely this is going to happen, how likely it is that your company will grow to 100 million euro valuation, how likely it is that your company is going to have 10 million euro in revenue. Okay, every single founder believes that this is certainly going to happen. We have the best idea in the world. Of course, we will create this. If you did not believe that your company is so good, then you would never come to us. So out of the 2,000 presentations that I hear, every single one of them says, we are very good. Now we have to be convinced that risks are manageable, okay? Now you do have to understand that what we do, of course, is as venture capitalists, we are dealing with risks, okay? We are used to deal with high risks, but still there are certain risks that are too high, okay? I had a startup who came to me to develop a spaceship. They had nothing else than the idea. I said, listen, we need 10 million of your money to develop the prototype of the spaceship. My answer was no. Very simple, because they had nothing else than the idea. There were so many risks involved in this that it was too risky for us. I actually believe that the guy might even potentially build a spaceship because he was a space engineer. But the chances that I will lose 10 million are so high that it's too risky for me. So we did not give them an offer ever. They were very disappointed. Now, if we like you and we believe that there is potential for growth, but still we believe that there is a lot of risks. So for example, that you don't really have any sales yet, okay? We like you very much and we believe that this is a problem. We believe there is a market. We believe that your team is good, but you don't have any sales yet. So for us, this is very high. This is high risk. Even if we provide you with an offer, this is going to be a take it or leave it offer. We're going to say, we're going to give you 50,000 euros for 10% of the companies. These are the terms. Either you take it or you don't take it. We are not going to negotiate with you. This is where investor dictates the terms. Okay. Now, if your risks are high, but not so high. So if you have a company, has some revenue, 100,000 euros in revenue, growing 20% a month. Okay. And say, listen, we need 1 million investment to increase the sales to reach 10 million euros in the next 3 years, and we already have 2 or 3 other investors that are interested, then we are probably also interested and you can also negotiate with us. So the real question here is, how much risks are you exposing us to, okay? Now, one thing that is very important to emphasize is that if you are not risky, then probably you are not for us, because we are a risk capital, okay? If you come to us, and we get a lot of those, say, listen, we will buy some property, some grassland in Croatia, and we're going to turn that into golf course. That's not for us. It's not our type of the deal. Why? Why do you think we don't like golf courses?
They're boring.
Well, that's one thing, but there is a mathematical issue with them as well.
It's a local business.
It's not scalable. Yeah, exactly. With golf course, you can create, I don't know, 100% return on investment, but you can never create 10,000% return on investment. And we are looking for this kind of growth. Okay. So if your perceived risk is low, like a golf course, then probably you should go to somebody else, not for us. We deal with the risky decisions, but even for us, some investments are too risky. Okay. Now, the good part of the story is that essentially, how risky you actually are, nobody knows. You don't know how risky you are, for sure, you don't know. But also we don't know how risky you are. So we are talking about the perceived risk, the perceived uncertainty of a certain future outcome. That you create a company that might have 10 million euros in revenue, okay? This is one possible development of your company. Is this the only possible development of the company? Of course not. We've invested in a few tourism startups in the beginning of 2020. And, you know, tourism was booming. Everybody, all the companies in tourism were doing very well. Well, guess what? We got COVID and lockdowns, and all the tourist investments that we have done are essentially worth more or less nothing at the moment. Okay, so what we are saying here is risk is subjective. It's very difficult to estimate the risk in an objective manner. You cannot do it, so don't tell me that you are not risky, because I know that you're risky, and you basically should know that as well. But also, we don't know how risky you are. Okay, that's why we have certain rules. You know, if you don't have any revenue, even if we like you very much, we can invest a maximum of 50,000 euros. Okay, because it's too risky otherwise. Okay, but it also means that you can actually influence our risk assessment. Okay, you can actually convince us that you are not so risky. Okay, how do you convince us? By preparing a very good story. This is why presenting your investment opportunity to investors like us, it's oftentimes described as storytelling. Pitch is a storytelling technique that you are using for this, okay? So those of you that will be able to make a convincing pitch, that will make a good story out of your business proposal, very likely have a better chance to get invested than those that don't. Because there is no mathematical formula, it doesn't exist and it will never exist, that will be able to objectively describe the risks that we as investors are taking on. At the end of the day, we make subjective decisions, okay? And you can influence our thinking. So for you guys to increase the chances to raise some money, you should actually drive down the perceived risk. How does that work? What do you have to do? Well, one thing that I keep coming back to is that you actually start getting some revenue. So for example, before you have the revenue, we simply say, we believe that your company is worth €500,000, okay? But as soon as you issue your very first invoice, when you get the first €1,000 in revenue, according to our beliefs, the value of your company has increased to €750,000. So the value of your business has increased by 50%, even though that the invoice itself was worth just 0.2% of the value of your company. So getting the first paying customer, a significant paying customer, has actually lowered the perceived risks that we as investors are facing by 1.26. So essentially for us, the risk has dropped by 2/3. Okay, this is why sales are important. Sales eliminate risks. And we can go even more into details, which risks in particular we are no longer worried, okay? Now, we believe that there are 5 areas of perceived risk, 5 areas where startups are risky, and oftentimes they don't understand that they are risky. Okay, size of the market, addressability, the business model, the team, and the cap table. You know what the cap table is? It's the ownership structure. Out of 100% of the shares in your company, who owns what? Okay. So you can actually lower the perceived risks that we see in your company by having good answers to all of these issues. Okay. These are 5 risk areas that we need to eliminate in order to be convinced that you are not so risky as we believe that you are, okay? So the single biggest risk for us is addressability. So can you actually address a market which is big enough to support the fast growth that I was describing in the beginning, okay? That's the size of the market, let's put it like that, okay? Geographic, are you only going to work in Ukraine? Are you also going to target Europe? Are you going to be a global company? Okay, the problem that you are, if you have a golf course, the problem that you are solving is probably very local. In the area where I live right now, in the 10 kilometers around this, there is no golf course. But if I expand the geography and say in the area of 100 kilometers around me, there are actually quite a lot of golf courses. So for me, the market is not really meaningful. Okay, it's too small. The product, you say, okay, we have the best possible product, this is going to do, and this is how it's going to do it, and so on and so on. But we need to understand, is this product really capable of delivering? We've invested into a company which said we have the product completely ready and we can start selling this tomorrow, and then they needed 2 years to really finish the development of that product because the product was not ready and they needed to change some things. And the first test has shown that these products get they don't work in that way that they were describing. So we really do want to understand, is your product ready? And it's not just the product, actually. It's also the manufacturing of the product. If you tell me that you're going to produce some product, some hardware, okay? So how much working capital are you going to need? How much, what kind of a business model are you going to have? What kind of a distribution channels are you going to have? How will you structure the company so that if you start growing, you will not run out of the products? How will you structure the company that if you don't start growing, you're not going to be left with a huge stock of unsold products, okay? So is your product capable of delivering? Is all of this. It's technical aspects of the product. It's also the working capital problem. That's why most investors actually don't invest into hardware, because the hardware companies need a lot of working capital. Okay, I can tell you right now, with our investment of 50K, in most software companies, this is enough for this company to reach some sales, so to have a product market fit. In hardware companies, it's not enough. In hardware companies, you would probably need 250 to 300,000 euros before you will know if there is a single person who is willing to buy this product or not. So for us, it makes a lot more sense to simply, invest into 10 software startups than into one hardware startup. Okay, we are distributing the risks. And finally, how are you going to sell? What is the cost of getting to the market? Everybody say, every startup that I've ever heard says, we have a big market, there is a lot of people out there. Well, let's talk about Facebook again. The social media networks today. How many users do they need to have to become profitable? What do you think?
Millions.
I've heard the number 100 million so that they are profitable. Okay. How much money will cost you guys to inform 100 million potential users that you exist?
Just use Facebook. They have all the people on it already, so.
For sure, but you are, you've come up with a brilliant idea to have another TikTok, okay? And so you need to reach 100 million people to make it profitable. How much is this going to cost you?
A lot.
If customer acquisition cost is €1 per customer, this is going to cost you 100 million euros.
Yeah.
Before you will know if you are profitable or not. TikTok actually did it. TikTok is the fastest growing social network in the history of humankind, faster than Facebook. But I would be very worried to invest 1 million euros into another social network, because I understand that they're going to need to raise another 99 million simply to just inform the potential users that they exist. Okay? In B2B sales, customer acquisition cost is more likely 200 or 300 euros per customer. So if you tell me that you're going to have 1,000 companies that will buy your product, for me that means, okay, 1,000 companies multiplied by 200 euros cost in order to acquire one company. That means only the cost of sales to 1,000 customers will be 200,000 euros. That is without all the other costs. Okay, this is how much money you're going to need. And I can tell you right now, 200 euros customer acquisition cost in B2B model is low. I've heard much bigger numbers as well from different startups. So can you actually access the market efficiently? That's another question. How are you going to do the sales? How are you going to do the marketing? And how much is that going to cost? So you need to have answers to all of these questions in order to convince us that our investment makes sense, that our investment will help you grow. Essentially, this is about how you get customers and how you get users. Nothing else matters for us. We don't care if you're a good team that get along very well. That's nice. That's not why we invested the money into your company, okay? We invested the money so that you grow your business. We did not invest the money so that you get along nicely and that you do have a nice team building, okay? We did not invest our money so that you will develop another 12 features of the product that nobody buys, okay? Essentially, it's about customers because this is lowering our risks. So if there is one thing that is important for you guys to remember from what I'm talking about today is Sales, sales, and sales are the three most important things that investors are looking at. Okay. It essentially shows you also how much time you need to spend on something. We get a lot of companies that say, oh, we're going to develop something new, a new technology. You know, we are working on AI blockchain marketplace, something. And then we need 300,000 euros from you. I said, okay, cool. Why? I mean, how are you going to spend this money? He said, well, first we need to pay the wages for all the people that are already in the company. So we need 100,000 just to pay the wages for the next 3 or 6 months. Okay. Well, what are these guys working on? Oh, these are developers. They are developing the code. I said, so 1/3 of our money is going directly into more product development. That doesn't lower our risks. What lowers our risks is if you sell. Okay. That means you need to dedicate resources. You don't buy developers if you focus on the sales. You need to buy salespeople. You need to invest into Google marketing, Facebook marketing, any type of marketing that brings you results. If one marketing approach doesn't work, try another one. Okay, you can actually use us and we will advise you. I've already given you some numbers. Customer acquisition cost in B2C customers is between 1 to 2 euros, sometimes more. In B2B segments, it's at least 200 euros, probably more than that. So this directly influences the business model that you're going to use, because this shows you how much money you're going to need to scale the business. Okay, get out. Okay, we are in the Balkans, so this is why we have this here. But the reality is it's too small market. The whole of Balkans have 20 million people. Ukraine has what, 40 million? Is that correct?
Yes, yes.
Okay, there are 7 billion people on the world. So that would be less than 1% of the global population lives in Ukraine. Okay, it's not a big market. If you come to me with a business proposal that will solve the whole problem in Ukraine, I will tell you, I'm not interested. It's too small. It's not convincing for venture capital to invest because the growth potential is limited. Okay. You can start there, and Ukraine and the domestic market is usually good to start there, but we do need to understand that you have the potential to become a big company, a big, say probably global company, okay? You will have to show that you can penetrate a foreign market. Just do it, okay? I've worked with Italian startups. You wouldn't believe how many Italian startups are afraid to go outside of Italy. Why? Italy is big. 60 million people, one of the top 10 biggest economies in the world. They speak Italian, which most Italian startups like, and they don't speak many other languages. And they can create a nice little business, 10 million worth, maybe 20 million worth of business in Italy alone. But that is, for us, for investors, it's too small. We are looking for companies that can potentially grow to the value of 100 million. And that is very difficult to achieve, even if you are born in Italy and you focus on the Italian market, okay? The second biggest issue for us after accessibility is the business model. At some point in the future, you will have to be profitable. So you will need to show the metrics that this is possible. And the basic metric is the one that I've been talking about, customer acquisition cost, the CAC, and the value of each customer that you get, the lifetime value of the customer, LTV. Essentially, we want to see that the value of the customer is much, much bigger than the cost that you have to pay to get that customer. If you are doing a business-to-business sales and your customer acquisition cost is 400 euros, I want to see that the value of that customer is probably at least 2,000 euros. So if your sales model to this customer is that for the first 6 months, he's not going to pay anything, then he's going to be paying 100 euros per month. That means that you will break even on this single customer only after 26 months. More than 2 years, you will be essentially making loss on every customer that you do. That's not really, that's too risky for us, okay? On the other hand, we know that Apple phones, for example, you know, they cost what, $130, and they're selling them for $1,100. So the difference between customer acquisition cost and lifetime value is probably 10 times bigger. Even though they have a business model that we generally don't like, it's still a good business proposition. So you will need to show us that your business is scalable. And one thing that investors really like a lot is monthly recurring revenue or annual recurring revenue. You have customers that are paying to you every month, and they're going to keep paying to you for 1 year, 2 years, or many years, hopefully indefinitely. Okay, this lowers the risks again for investors to see that you are gaining monthly revenue. Okay, so to give you some, okay, but let's stop here. Do you have any questions, any comments so far? Nothing? No? Okay, guys, I'm gonna go on then. So one very, very clear advice: if you want to raise money from investors, selling is the key element here. It really lowers the risk of investors. If you are hiring people, hire them in the sales team or marketing, sales marketing. And if they don't perform, if they don't bring results, change them very fast. Hire quickly, fire quicker, okay? This should be your main focus as well. You as the manager of the company should probably not spend 90% of your time writing code for some software. No, you should be focused on the most important thing in the company, which is selling. In the beginning, when there are only a couple of people in the company, you will probably have to do the sales yourself. Then when the company grows, you'll have a dedicated salespersons and you're going to have a dedicated sales department, but you still want to know everything that goes on there. The next thing is, you know, we will be looking at you. If we give you some money, we'll be looking at you. How are you spending this money? Are you really achieving the results that you have promised us? Recently, we have invested into a company which has some significant revenue. So I think they made almost 1 million in revenue last year. But when we invested, they said, listen, we're going to double the sales every year. Last year, they increased the sales for 25%. It's not a bad result, especially for COVID year. The growth in sales for 25% is okay. But this is not what we invested into. We invested into a growth of 100%. So this year, they need to grow by 200% to recover of what they didn't achieve last year. And guess what? These guys are not growing even 100% per year, even this year. So they are not executing what they said they will do. They are not bringing the results that they promised us. Okay. If you're late, and if you say, okay, the first month we're going to do something, in the second month we're going to do something else, and then you're delayed by 1 month, that is already 5 to 10% of the whole time that you have available. I mean, if you remember, I said, when you raise money for the next 12 to 18 months. So if you're 1 month late and you only have 12 months time, that's a significant delay. So if you say you're going to do something, do that. Hit your targets, okay? Measure yourself, measure your own performance, measure this objectively. Don't say, oh, I have 1 million downloads of my app on Apple Store. And at the same time, you know that 95% of those people who have downloaded this will actually never use this, or they use it once, your app, and then they never use it again. You know, measure your own performance and report it, and also report it to us. I get reports from startups all the time. And if you don't achieve what you're saying, ask for help. Don't hide from us. The company that said, listen, we have the product ready and we're going to start selling immediately, and then they did not start selling for 2 years because the product was not ready, they were literally hiding information from us. They didn't want to say, listen, we are delayed and the product doesn't work as we said we will. So we actually didn't know what's going on. We were sensing that something was wrong. And we sent them an email and got no reply. And I picked up the phone and called the guy. I said, listen, what's going on? Oh, yeah, we are a bit delayed, but you know, COVID, blah, blah, blah. The last year, every delay is because of COVID. You know, also in businesses that have nothing to do with COVID whatsoever. Listen, if you don't reach your results, tell us, inform us about it. We might be able to help you. And for sure, we will be able to give you some advice. Because if you said that your company is going to grow for 100% a year and it doesn't, but your cost has increased by 100%, you are going to run out of money in less than 12 months. You're going to run out of money in 6 months' time. So advice that we will give you is cut down the cost. And this is advice that no startup ever wants to hear. Okay? But it's the right advice. Okay, raising money is like trying to lose weight. It's not easy, and you need to focus on this. It requires a lot of dedication. I mentioned to you before, a startup that I know had 150 presentations to investors before they raised 1.5 million. The easiest place to go are already your existing investors. So if we have invested money into you and you're doing a good job, come back to us and we might invest more money into you. That's going to be the fastest and the easiest way how you get money. But don't take us for granted. We might give you more money or we might not give you more money. It's our decision to make, not yours. Okay? You never know where you will meet some people who can invest. You never know that. So always be ready to have your basic presentation. And if people ask you some key data, some key information about your business, you should be able to answer them. If I ask you, how much is your customer acquisition cost? You say, oh, I don't know. Then for me, that increases the risk. Okay, this founder is not credible. But if you say my customer acquisition cost last year was 212.5 euros, but this year it's gone down a little bit, so it's only 201 euro, and say, okay, this is a credible founder. He knows what he's talking about. And also try to keep going, try to keep growing also while you're raising. I had a startup now that for different reasons, we wanted to invest money already in October and we only invested money now. It wasn't our fault, it wasn't also their fault, but it just so happened that for 6 months, the guys were actually with zero money, no money whatsoever. Guess what? They sold 150,000 euros worth of services in that time when they had 0 euros on the bank account. They were fundraising, they were raising the money, but they were still doing some things. And now that they have the money, they are paying the cost for behind. Now they will grow much faster. And here we have some mistakes. So most deals don't happen. I think it is important to understand that it's difficult to get people interested and it's difficult to get people that are going to invest some money. So it's always a good idea that you talk to several people and several deals at the same time, you know, because even if people tell you, okay, we're going to do this, we're going to invest this, it's still quite likely that's not going to happen, that they will not. If there is obvious that some people told you, okay, we're going to invest money, and then they did not come back to you in the next 1 month, and they are not answering your emails, and they're not picking up the phone when you're calling them, they're not going to invest. Even if you need the money urgently, even if you believe them, even if they're not your friends, some deals go bad. These things happen. We've seen that a lot, okay? A very good idea is to have a term sheet. So a term sheet is usually one piece of paper, one page. It can be longer, but usually in our case, it's 1 page, on which we simply write down all the basic things that we discussed. We are going to invest 300,000 euros for 15% of the company. These are the standard conditions. Our offer is valid until the end of this month. And we're going to invest for a convertible loan agreement that we will supply to you if you confirm the term sheet. Okay, so this is an understanding and it's written down, so people cannot change their mind later and say, oh no, but I thought we were talking for 300,000 euros for 10%. I said, well, that's not what we have written down in the term sheet. It's 300,000 euros for 15% of the company. You know, it's not, if it's written down, then this is what it is. Try to understand us as investors. What are we looking for and what our goals are. And again, whenever you find somebody that is that looks like an investor that might be able to give you some money, pitch to them. If you have a 3-minute pitch, you can actually do a lot of these presentations in a very short period of time. And that is actually my last slide right now. And I'm going to stop talking here because I want to hear some questions and I want to hear some, I can answer some, probably most of the questions that you have, okay? So do you have any questions?
I do have. So, Ales, can you tell us, so what kind of research do you usually do in terms of a startup? For example, if they send you a pitch and you're sort of interested, so what kind of research do you do usually? So,
What do you mean?
I mean, do you check their social media, or how do you understand that they're credible before you have just set a meeting with them? So
No, we try to meet with them as often as we can. I mean, we have a very simple rule. We are free partners at our venture capital fund for a significant investment, everything more than 100,000 euros. All three of us have to have a meeting with them, usually separate meetings. So we talk with the guy at least 3 times in person. I mean, in person over Zoom. But we also ask for a lot of information, a lot of other information. Okay, so in the process, it's called the due diligence process. We will be asking a lot of questions. You will be providing a lot of information from us. In this process, if you say, listen, I'm not going to show you some information, for us, this increases the risk in 2 different areas, actually. So it doesn't make much sense to hide information from us, because it's very easy for us to say, in that case, we're not going to invest. Okay, so share your information. What you can ask for is an NDA, so that the information that you provide to us, that we don't disclose to others. But that's, you know, we are investors. Investing money into companies, it's like getting married. You know, we want to know you, but obviously you also want to know us. We are not, we're also not hiding anything. And you can find on our website, fuelrishcapital.com, you will find every single investment we have ever done. You will see the amount of money we have invested. What you will not see is the actual deal, so the equity stakes that we get, but you can imagine it is usually around 10%, rarely more, and also not very often that it's rare than 10%. So we are not really hiding anything from you. And we are also more than willing to answer all of your questions. Irina says, what do you mean try to know your investors? This is, I mean, try to understand what we are looking for. There are certain areas that we know very well. In our case, that would probably be telecommunications, to some extent e-commerce, to some extent AI technologies. What we don't understand is hardware, and we believe that hardware is too risky for us. So if you come to us with a proposal to invest into hardware, you would probably, I mean, it would make sense to just ask us about our previous experience with hardware investments, because we will tell you we have 0 good experiences with hardware. We've lost money on all of them. Okay. Is it information, behavior, or way of thinking? All of it. We want to know you as well as we can. Again, we are getting married. We will be partial owners of your company. Okay? That is a very close relationship. So are we going to check your social media? We might, yeah. Are we going to ask other investors that have already invested into your business before? For sure. And we also get a lot of questions from other venture capital funds for the companies that we invested into. So it's also a good idea to be in close contact with your current investors, because if you need more money in the future, first of all, it's the easiest way to get more money from investors is to get to your existing investors, say, listen, would you invest more money? But second, even if you go to some other investors, they will probably call us and say, listen, how do you like these guys? And we will tell them. Okay.
So would you advise then that we look for the right capital investment? So if you are focused in software and artificial intelligence, then would you reject other, I don't know, technologies that may look good, but you don't know enough about it?
That's a very good question. Well, there are some technologies that we would reject, yes, mostly because we are not allowed to make certain investments, okay? Regulated financial solutions are something we are not allowed to do, so we have no choice but to reject them. Blockchain in general, we know well enough that we are skeptical about it, especially cryptocurrencies, okay? because oftentimes they claim to do something which is not necessarily true. They claim to solve a problem which is, in our opinion, not as big as they believe. Now, are we going to reject you exclusively because we don't like something? Probably we would gather more information, and we would also very, very directly tell you, listen, this is what we don't like, okay? We don't like the fact that you are producing hardware. Could you turn your solution into a software solution because it is much more scalable? We've actually done that before. And this will make you think and say, listen, no, we can't really, do this in a software way. So this is what we are stuck with. Then we say, okay, but can you change this into subscription business model? Instead of people buying your product and owning your product, can you actually rent them this product for a certain amount of money? Because this will create monthly recurring revenue for you. So through these discussions, we will be very clear, okay? We're not really hiding any information there. If we see, we had this example once, a startup which has gained an investment from another investors previously, and then 2 days after they got $500,000 investment, 2 days afterwards, both founders had new BMWs, and they were driving around the city and they were posting photos of themselves in new BMWs. That didn't look good, okay? And we asked them, listen guys, what did you do with the last batch of money? Oh, we invested into business development. Really? What about this picture here? Oh, So when we reject you, you will usually know why.
I have more questions, and maybe other people has more questions, so I will stop.
So I have another question. So what percentage of the company you usually ask for in exchange for, let's say, seed round of €1 million? So what startups should expect to give in exchange for money around 1 million?
Yeah, that's a tough question. So if you're pre-revenue, you don't have any revenue, we will give you a template deal, €50,000 for 10%. You don't like it, you can get the money somewhere else. We don't care. Once you have some revenue, it depends on how fast you are growing. So how fast the revenue is growing, it depends on other factors. But I think that the good rule of thumb would be if you had in the last year, or maybe this year, depends, but much better last year, if you had $500,000 in revenue, for us, the implicit and growing, so $500,000 and you are growing fast. Let's not forget that, okay? We would be looking at a valuation of 10 to 15 times that time. So if last year you have $500,000 in revenue, this year you're going to have 1 million in revenue. For us, the value of your company is probably between 5 to 10 million euros. So for 1 million, we will be looking for between 10 to 20% of your company. Okay, it's now this very, very rough calculations are different in the United States. They are different in Western Europe. They are different in different industries also. But I think it's a good rough estimation. Okay, 10 to 15 times the revenue that you had in the last year, but this revenue needs to be growing fast still. Okay. So to get 1 million investment, it's also one good idea is also to have several investors. In our case, because this lowers the risks for us. Maybe we didn't see something. Maybe we didn't check out your Facebook page and didn't see that you're buying BMWs every time when you get invested. Then if there is another investor, the chances are that guy will actually look at your Facebook. So this is lowering the risk for us, and for us, this is actually a good indication. Yeah.
Sorry, do you require to know which other investors are investing in that?
Yeah, for sure. Usually it's an investment round. Usually say we're putting together a round of 1 million euros. We were thinking that you might be the lead investor with $500,000, and we would get 2 other investors for 250 each. That happens quite often. Okay, it lowers the risks for all 3 investors, For you, you get, I mean, essentially the same condition that all the investors get. So in a way you can get, you know, in a way it's a better deal because for you as well, because you get more people who are motivated to help you succeed. Okay. So co-investors usually are pretty good idea.
Mm-hmm. And I have another question. So if somebody is developing a medical device, is it too risky to invest in it when they still don't have the approvals from FDA and all these regulatory bodies? When is the moment to start investing in them?
There are special investors who invest into medical devices.
Mm-hmm.
And usually they invest into different stages as well. So you have investors that invest in the early stage of medical devices. Then you have investors who invest into a bit later stage. So the answer for us would be yes, it is too risky. We don't know med tech devices good enough, plus it's hardware usually. So it's not really our focus. But listen, in Europe alone, there are probably around 500 venture capital funds. So you have all types of investors. For sure, there are specialized investors in medical tech devices, and you should ask this question to them.
Thank you.
They know much better than we do.
Mm-hmm. Okay, more questions? It seems that we don't have more.
Guys, in Poland, the way I hear it, and I'm not 100% sure about it, but I think it's close to the truth. Apparently, Poland has invested more than 500 million euros into venture capital funds. So if that is true, and we know we have a few investors that we know in Poland as well, we co-invest with them sometimes. If that is true, that probably means that there is more money than startups in Poland. Okay, so it's probably much easier to get investors in Poland than, for example, in Croatia, where we are the only investor. Okay. You know, 500 investors, 500 bags of money looking for good startups. You know, is it easy to get money? It's not easy. It's really difficult to get money, but is it possible? It is possible. Yes. Difficult, but possible.
Mm-hmm. Thank you for the encouragement.
Yeah. So thank you so much, Ales. So many great insights into venture capital. Personally, I found many new things that just were an eye-opening for me. So thank you so much. It was really great.
Don't don't be afraid to ask questions to all the investors.
Yeah.
As I said, get to know your investors. Ask them questions, because it's gonna, even if you find out that this is not a good investor for you, it's gonna save time both for you, but also for the investor. You know, it did happen to us as well. We've been negotiating with the startup for 1 month before we discovered that there is no way how we can make an investment because there was something that didn't fit. It's much better to get a fast no than the long yes.
Yeah.
The long yes usually turns into a long no.
But do you think that through your questions, the investor can gather that you are really inexperienced? So besides your...
But of course, but you are inexperienced.
Yeah, besides your engineering, then the investor will maybe think twice that, oh, they are so inexperienced in this type of business that...
Listen, through the due diligence process, they will get to know you very well anyway. I mean, you will not be able to hide the fact that you're inexperienced. I wouldn't even hide it anyway. I mean, it's not necessarily a bad thing that you're inexperienced. This is not your field of expertise. Your field of expertise is to create the best product and then to create the best company. For financial aspects, you don't have experience. That's why you're asking questions. It's always a good idea to ask questions.
Yeah. Okay.
Don't be shy. They will. And if they don't want to answer some of your questions, then you also should maybe be a little bit careful with such investors. There are some strange investors out there. In my opinion, they're not even investors. Okay. But as I mentioned, our fund is one of 500 funds in the European Union. We are professionals. This is our main job. Our main job is to find 2,000 startups, review them, and make 50 investments. And we're going to do that for 4 years. Okay.
Mm-hmm. Would you invest in a company that is not a startup, that is already quite old? They just want to grow more.
The problem with those companies is usually that they don't grow fast enough. You know, for a big, I'm going to say a bit older company, 20 or 30% growth is spectacular. For us, it's way too small. I mean, quite honestly, a rule of thumb that I use, if your company doesn't grow 10% a month, or at least if it doesn't have the potential to grow 10% a month, then you're probably not a venture capital material. Mm-hmm. Big, older companies, they don't grow 10% a month.
Okay. Okay. Thank you, Paul, and thank you, Ales.
For these companies, there are other investors. Don't forget that for big companies, there are, for example, private equity funds. They are looking for less risk, but also slower growth. So private equity funds, there are actually more private equity funds on the market than venture capital funds. But venture capital funds, we focused on these extremely fast growing companies. And we expect that 80 to 90% of the investments that we make will fail, that companies will not make it. Mm. But the 10% or the 15 or 20% of the companies that will make it really big. And we will cover all the losses. Private equity funds have a different strategy.
Mm. I see. Wow.
So there is always a certain type of investor for certain types of businesses and startups.
Yeah, it's a whole jungle out there. You know.
You can always find a good fit. Yeah, if you look for it. Yeah.
Yeah, true. Okay, guys. If you have any questions, don't hesitate to ask me, and I wish you all the best.
Yes, thank you for having helped us once more. Good luck.
Thank you all. Thank you, Ales. So it was a great session. Have a nice evening. Bye.
Bye.
Bye. Bye. Thank you.
Bye.